Welcome to YieldNerd, an educational show about how you can acquire and manage yield. Let's try and learn about which industries issue preferred shares. And I have a small story. A long time ago, and this again goes back to the Depression and even before that, railroads were trying to complete their project, and people would finance railroads. At one point, the American Railroad was a whole bunch of private corporations, and they would go raise money. People would raise money to create banks and banking. There wasn't a federal central banking system as well. And so banks would have minimum deposit requirements. They still do. Railroads in the early years had huge capital requirements that initial shareholders couldn't come up with. And so that was the genesis of preferred stocks. And even to this day, there are certain industries that are very prevalent when it comes to preferred stocks. One of them is banks. Banks do issue a lot of preferred stock. Utility companies also do that, although nowhere near as much as banks and the financial sector in general. Business development companies, companies that issue loans. As a matter of fact, 85% of all preferred stock come from the financial sector. Now, why do I bring that topic up? For one simple reason. If you think you are buying bonds in a certain sector and you now want to add preferred stock in another sector, remember that there is a very high correlation between a random preferred stock and the financial sector. So be very smart about which preferred stock you buy, and we'll go into great detail when we get further along the episode. I need to declare a citation, which is a wonderful thing for you to read, and I'll be sharing some highlights from that. This citation is called What Are Corporate Bonds? And it is by the SEC. And this series of documents is called the Investor Bulletin. And it's something you can subscribe to. It's a wonderful read. You can Google sec.gov, what are corporate bonds, and you will see how you can sign up for investor bulletins. And that article discusses how bankruptcy works and how people stand in line to get their money back. And in the tomato farm case, the tomato farm yield investor has a fear. Hey, I gave you my $100. How do I know I'm going to keep getting my $2? And how do I know I'm going to get my $100 back? And this is from an older episode. If the farm owner misses a payment, or if the farm owner says, I can't give you your $100 back, the creditors may say, I want to hold a lien on the farm. The very first creditor to hold the very first lien, meaning if there is financial distress, the first lien holder is the one who gets to put the assets up for sale and collect some or all of their money first. That's the first lien holder. Behind them, let's say that the first lien holder had lent the farm $100, the farm was worth more than $100, then you go to the second lien holder or the securitized lien holder. Then you go to the unsecured debt or the subordinated debt or a debenture as it is called. Then and only then do the preferred stock dividends get cleared. And finally, common stock. However, there are some others here that we have not even talked about. What happens if the company, if this farm, for example, bought soil and somebody supplied them soil? Another company gave them fertilizer. Where do they stand in the queue? And the answer is some of these suppliers may have their own process of having collections. They may have their own restrictions, and depending on if it is a small farm and a big supplier and things like that, they may have created liens on their own side. They may have created securities on their own side. So this kind of focus on what happens when the company is in distress is its own industry, and there is a lot of litigation that happens there. It's a very complex stream. So the reason I'm bringing all of this up and discussing the SEC Investor Bulletin on corporate bonds and preferred stocks is so you understand that preferred stocks are somewhere in the continuum, but ahead of preferred stocks is a series of other lien holders, bond holders who will get their money back first before you do. All right, let's talk about the risks of owning a preferred stock. Now, remember, a preferred stock is a combination of a stock and a bond, and that is what makes it interesting. In order to dive deeper into this, I'm going to issue another citation. This time it is an article by SP Global, and this is digging deeper into the US preferred market. If you Google S&P Dow Jones indices, digging deeper into the US preferred market, this is about a 70-80 page paper, and I'm going to review some highlights from there, and you're welcome to Google and read the whole paper. And the first thing I was going to show you is that, and you actually don't have to pay attention to the exact numbers because yield, as you know, varies based on many other factors. But in general, preferred stock yields are higher, significantly higher than corporate bond yields. Now, why do I say that? The reason I say that is we have our personal yield curve that we try and construct. Some of you may remember we started looking at treasuries, and then we looked at agencies, and then we looked at munis, and then we looked at corporate bonds. If preferred stock yields are higher than corporate bonds, what does that do to your income portfolio? That is what we're going to understand in this particular episode. Another thing which is a risk of a preferred stock is the credit rating. The credit rating of a preferred stock is lower than the bond for the same company, and there is a specific reason for that. You are lower in the pecking order compared to bonds. So you may find a company that has a AAA rated bond, but the preferred stock may be single A. Quite simply because if the company has a lot of debt load and it has issued a lot of bonds, the preferred stock's likelihood of getting paid is much lower. So you got to be very careful about what kind of companies you buy preferred stock from and whether you've done your homework, and we'll talk about what that homework will look like as well. Another risk of the preferred stock is interest rate risk. And this is what we are seeing a lot of in this year 2022, because when the federal funds rate or the treasury rate goes up, it does a lot of, creates a lot of turmoil for any of the higher risk investments, because the lower risk interest rate is now substantially higher, which means the average individual would rather buy the lower risk and get a higher yield than buy the higher risk and higher yield. So in this scenario, as the treasury yield keeps going up, preferreds, which are somewhere around here, north of corp, that will go down because preferreds are a higher risk than treasuries or agencies and so on. So remember that as interest rates go up, your preferred stock prices will come down. Another risk is volume. This is a stunning number. Every single day, $500 billion of treasury bonds are traded back and forth. Preferred stocks are a drop in the bucket. They are about 3 billion a day. What does that mean to you? It means there is a higher spread, meaning if you have to buy a preferred stock, you may say, I want to buy it for $25.01. The seller may say, I only want to send it to you for $25.25. That spread is very wide. However, in areas where there's a lot of volume, the spread tends to be very narrow. There are ways in which you can think different, and we're going to talk about that as well, but realize that volume is much lower for preferred stock, and that means spread tends to be higher. Another risk for preferred stock is what we have harped on quite a bit, which is bankruptcy risk and credit risk. So you may not make your money back if the company goes bankrupt, and you are seventh or eighth in line because of all the reasons we have talked about earlier. The last risk is industry concentration, and as we talked about earlier, 85% of preferred stock focuses in financials. So if in your income portfolio you bought bonds from financial related companies, be careful. Don't go around buying a whole bunch of preferred stock from financial companies as well. The last thing you want to do is stand in line twice with the same company. So we'll talk more about how to think different about this as well, and there are ways to be smarter here. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.